Hello, everyone. Today on the final bar, I'll be talking with David Hunter from Contrarian Macro Advisors. We have some targets to share with you for the S&P, for gold, thinking about the overall trend and rotations that we've seen. Happy raging bull market with the S&P up another 1% today. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts. The StockCharts platform is built to help us better understand investor psychology and appreciate investor behavior through the lens of technical analysis. Let's focus on the message that the markets provide back to us in the form of price and trend and momentum. When you look at the S&P over the last couple of days, you get sort of this renewed influx of demand, right? Influx of buying power, with the S&P finishing strong yesterday, pushing above 4,000, finishing strong again today, finishing at the highs of the day around 4060. That's up another 1%, but the NASDAQ 100 up 2% today. So we're seeing renewed leadership for areas of the market like technology. The number one sector today, energy, with some of the key energy stocks like Chevron and others reporting earnings this week, continue to push the market onward and ever upward. We'll look at the chart of the S&P, how we've broken above trendline resistance. We're above the 200-day. What is next? We'll see what sort of questions we can answer together here through the course of the show. Let's continue on here today with our market recap. Let's dissect a little bit about what we saw and what we heard thinking about the market activities. We'll look at some individual names if we have time as well. And then we'll take a brief break here. The S&P 500 finishing the day, as I mentioned, around 4060. That's up another 1%. And while, up 44 points, up 1% does not sound like a huge move. What's compelling to me is this comes after yesterday, which was a nice up close. And you have sort of what today I would argue is a follow-through day, right? Just we had the break above the 200-day. We had the break above a trend line. Now we're actually following through to the upside. So it's seeming less and less like this is just an isolated sort of test of resistance. You're actually starting to see some moves through resistance, some continued push to the upside. Now, it's driven in a lot of ways by some of the most important stocks. Tesla up 11% today. That's not going to hurt some of the benchmarks and some of the sector ETFs to move higher. Let's look elsewhere. As I mentioned, the NASDAQ 100 up about 2%. That was the biggest gainer in our list of broad market indexes here on our front page. The VIX actually moving below 19. Yesterday, I was talking with Katie Stockton from Fairlead Strategies. If you missed that one, absolutely go back and check that out. It was a really good conversation about a number of different things. But one of the things we talked about was just this idea that the VIX is relatively low compared to the range over the last 12 to 15 months, right? VIX around 20 has been a pretty reliable sell signal for stocks in 2022. Is this different, right? Is this time different? Is 2023 a new year? Do we see a sustained rally on lower momentum, or not on lower momentum, on lower volatility? That's certainly a possibility. The VIX around 20 is a level I would certainly be watching. Today, stocks higher, volatility lower, sort of playing into that potential narrative that we rally, and it's more of a slow and steady rally. It's not something we've seen yet. It's felt much more like sort of a V bottom, right? An aggressive buying off of the lows. Interest rates overall moving higher. 10-year yield up about, let's say, 30 basis points, up to just below 3.5%. Dollar index up about 0.25%. That's using the UUP, which is a bullish dollar ETF. Commodities overall a little bit mixed today. Gold and silver essentially flat. The GLD, which is a spot gold ETF, was down about 0.9%. The broader commodity space doing just fine. As I mentioned, a lot of earnings this week for energy stocks. Glancing here, we had, Valero today. Tomorrow we have Chevron. Hess was yesterday, right? You got a number of companies reporting earnings, and you're starting to see energy stocks follow through in a way they had not necessarily up until the last week or two. So certainly an area of the market to keep focusing on. Cryptocurrencies overall a little bit mixed as well. Bitcoin flat for the day, actually sitting above 23,000, which is important after rallying above there yesterday. It's traded below 23K a couple times, but keeps managing to bounce higher. Ether, on the other hand, is bouncing off of 1,600. getting above some of those key round numbers, for example, 20,000 on Bitcoin, getting above 22, 23,000 is good. Staying above those levels, following through to the upside is what I would argue is it gets most constructive about some of those charts. You're starting to see that actually play out. I want to talk with my guest in a little bit, David Hunter, about the S&P 500. He certainly has some objectives that I want to talk through and start to think about. When I'm looking at a chart of the S&P, this big green trend line, I've mentioned with a number of my guests the importance of this trend line as I'm looking at it, which is why it's become thicker and thicker every day. I feel like as I'm using it, I kind of make it bigger because it just seems more and more we keep reinforcing the importance of that line. And I think what that does is two things. Number one, every time you retest a line like this, it keeps reinforcing how it's a great, accurate visual representation of the pace of the trend. And we've continued to see the markets obviously trend down over the last 12 months. But how things have evolved over the last couple of months, we put in a pretty significant higher low. It's starting to seem like here in December. It's the first really major higher low we've seen in quite some time. And now we're actually breaking above that trend line. So the more you confirm the trend line with retests, the more important it becomes. And that also means when you finally break through it, which arguably we're doing this week, that all of a sudden becomes a much more significant breakout than you might have thought otherwise. Momentumly is not a word. Momentum-wise, you can see that we're breaking above an RSI level of 60, which is something we've not really seen since back in August, last time we retested the 200-day. So starting to, again, see some follow through to the upside, which I think could certainly be compelling. Just quickly, let's look at a breadth measure or two, because I had a lot of questions recently on breadth conditions. Two charts I'll share with you. Number one, looking at the stocks, maybe three. Look at the percent of stocks above the 200-day, percent of stocks above the 50-day moving average. These are classic measures of breadth, looking not just as whether the S&P is above its 200-day moving average, which it is the S&P above its 50-day? It certainly is. But what about all the individual stocks that comprise the S&P 500? What about those 500 stocks? And are they agreeing with what you're seeing with the broad index? What's interesting is these indicators both went above 50% back here in November. So while the S&P was just trying to get above its 50-day and well below the 200-day moving average, the average stock arguably had already broken out. By mid-November, you have over half of the S&P members above those two moving averages. In December, when the S&P pulled back and actually traded below its own 50-day moving average, over half of the S&P members actually remained above its 50-day and 200-day moving averages. From there, they've rotated even higher. So as of now, just over 7 out of 10 S&P members are above their 50-day moving average. That is not a bearish reading on this chart. As you can assume by the fact that I'm looking above and below, this shows you there's been a big influx of demand, and that is, I think, reflected best by the strength that we're seeing in price. But certainly these breadth indicators show you that it is not a narrow advance with a relatively small group of stocks participating. It is more of a broad advance with a large group of stocks that are participating. Overall, that's more of a bearish sign than otherwise. Also want to talk about the McClellan oscillator, and that's $NYMO. This is from Tom McClellan, actually his parents, Sherman, and I forget Sherman's wife's name. I apologize what her name was, but the two of them, the two McClellans, Tom's parents, actually created this McClellan oscillator as a way of tracking momentum. And it's adapted from advanced decline data and using it to understand, smooth out some of the noise and look at the trends overall. When the McClellan oscillator is above zero, that tells you overall conditions are bearish, as defined by the strength in the breadth conditions underlying the indicator. We went above zero at the end of last year, and through so far in 2023, it's been all above zero. So if we would get some sort of pullback, the question would be, can we hold that zero level? At this point, it's more long and strong, telling you conditions are fairly constructive and that the average stock is actually participating in the uptrend just fine. Do want to talk about some of the names reporting earnings here to wrap up our market recap. Tesla, the biggest gainer in the S&P 500, as I was checking a few moments ago, up almost 11% today. That is a decent move to the upside. Now, what is impressive about a chart like Tesla, and I'd probably group Meta in that as well, you've had these almost V bottoms and accelerations to the upside. What's striking on the chart of Tesla is from the low here, which was only about 2 weeks ago, 2.5 weeks ago, from that low the first week in January, we really haven't had a significant drawdown, right? It's been a couple days along the way that have gone down, but overall, it's just been continuing to push the upside. So literally, we made a new low. We had what's called a bullish engulfing pattern on the low day as Tesla just barely stayed above 100. And from there, we're up quite a bit from about 110 to 160, which is a nice kind of 50+% rally off the lows. Not too bad. and pushing Tesla to the upside, back above its 50-day moving average for the first time since September. What's frustrating and challenging about a chart like this is if you're waiting for a pullback, you're still waiting. Same thing can be said for something like Meta, right? If you're waiting for a pullback as an entry point, we haven't seen a lot of those, right? And there's not been a lot of evidence suggesting that there's an opportunity to buy in on short-term weakness. Meta, for its case, is actually overbought right now. And a lot of times, overbought condition means at the very least you get a bit of a drawdown. Tesla has not become overbought yet, but as I'm looking at some of these names rallying, gapping higher, up 11% on a mega cap, or certainly a large cap name like Tesla, certainly something to watch as the momentum continues to improve, as we continue to make new swing highs, get above the 50-day moving average. Do we become overbought, which might indicate a bit of an overextended condition at this point? Tesla not flashing that sign just yet. It's actually suggesting the trend is very much in place. Energy, I mentioned a lot of energy names reporting. We had Hess before the open on Wednesday. That was yesterday. Tomorrow we have Chevron gapping higher by about 5% today, testing a new long-term high. Hess is another name to hit on making a new 52-week high today. So energy stocks that had pulled back in December actually starting to really rotate in a pretty decent way back to the upside. That might be an important theme to certainly watch. The renewed strength in energy, despite the fact that crude oil not necessarily going up too much. Just to finish off with some names and not doing well earnings wise, two to highlight for you. Sherwin-Williams is the materials name. There are a lot of compelling charts in the materials sector, and we'll talk about some of those when we have time to do so, but a number of them having pretty constructive patterns. Sherwin-Williams is one area where you're not, obviously in the specialty chemical group, gapping lower today on earnings, and actually the momentum getting a little more negative as well. Also IBM, pretty big part of the technology sector, gapping down about 4.5% today, testing its 200-day moving average from above. So in general, I think it's always a good time to own good charts, things rotating lower, things making lower highs. Much less ideal, I would say, than things that are rotating higher, showing an influx of demand, showing signs of accumulation. And I'm not struggling to find those when I look at the equity and ETF landscape here. Let's take a quick commercial break. We'll be back with David Hunter. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close. We have so many great plans for the show through the course of this year, including being in our brand new studio. Hopefully very, very soon. We're going to be running some tests at the beginning of next week. We'll continue to hopefully rotate into that studio very, very soon. We're going to be changing the show and evolving it over time, including some really good guest conversations, which I'm excited to share with you here going forward. Before we bring on today's guest, David Hunter, a couple other quick announcements. First off, we welcome your questions. We're going to do a mailbag segment on Friday's show of this week, and we'd love to answer one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll hope to answer your question live on the air on Friday's show. Go to StockChartsTV.com. That is our on-demand platform. Larry Williams, Martin Pring, Bruce Frazier, many, many other fantastic guests have shared their market outlooks, have shared their insights and expertise. All of that educational content is available for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. Coming up schedule-wise, we have our conversation with David Hunter of Contrarian Macro Advisors here in a few moments. Coming up next week, as a reminder, Monday and Tuesday, we'll actually be running the show a little bit late at 6 p.m. Eastern because we will be doing some testing and things in our new studio. On Wednesday, we'll be back with you live on Wednesday, February 1st, Fed Day. We'll have Sam Stovall of CFRA Research helping us debrief and unpack what we heard from Chairman Powell and the Fed meeting Tuesday and Wednesday of next week. I want to welcome on today's guest, David Hunter. David's the Chief Market Strategist at Contrarian Macro Advisors, coming to us from New England. David, Happy New Year. Welcome back to the show.
Happy New Year, Dave. Thanks for having me.
It's great to see you. You never disappoint, I think, by coming on and bringing a true contrarian point of view. And I appreciate you, bringing some opinions and stretching our thinking a little bit. When we talked before we went live about the S&P 500, you told me a little bit about your outlook through the course of the coming months through the year. Can you talk us through what you're expecting from stocks here going forward?
Sure. I actually think 2023 may be a record-setting year, a year unlike anything we've seen. I've been doing this almost 50 years now, and I think this may be unprecedented. I'm calling for the S&P to get above 6,000. I have used the number 6,000 plus because I don't know whether that means it's 6,200 or 7,000, but I know that sounds like a crazy reach from here, especially with the majority of investors looking for much lower rather than higher. But as you know, I mean, we've been hearing for months that we're in a bear market, and that anything we've had since the October 13 low is just a bear market rally. And I think we're just beginning to disprove that. As you said, we broke above the 200-day, and we're breaking above that trend line as we speak today. And I do think the next stop is probably 4,300, and then from there 4,600. And I don't think it'll take very long to get to either one of those levels. From there, it's a little hard to tell whether we have, a 10% pullback or whether we push through and just keep going. And I'm kind of known out there for using the term melt up. You see that term a lot now. I say a lot of people misuse it. My melt up definition is the parabolic end of a secular bull market. I think this bull market started in 1982. I date it back to then. Some people want to date it from 2008-9, but I think that was the beginning of the disinflation trend, the beginning of interest rates peaking at 15% and coming down to zero. So PE multiples expanded, et cetera. So I think we've been in a 40, now almost 41-year bull market and secular bull market. And I think 2023 will mark the end of that bull market in a final blow-off move that takes you, to levels that nobody can foresee right now. As I say, 6,000 to 7,000 is my best guess. And you're seeing the breakout in the Dow already above the 200-day. It's been there for a little while. The Russell's been there. The Nasdaq's right at the 200-day now, I think, and the S&P is just breaking above it. So I think we're in gear, and I think the bear ended on October 13th.
It's been an incredible run off the October lows for a number of those indexes, obviously. And you've seen such a rotation, right? From making a new 52-week low to all of a sudden accelerating to the upside. We're obviously in the meat of earnings season here. And then we have the Fed coming up next week. When you're thinking of, I would imagine if the S&P is getting to 6,000, we would probably have to get out of this tightening cycle in some way relatively quickly to make room for that. When you're looking to the Fed next week and in the coming months, what are you expecting to hear, or how does that play into this vision for stocks?
Sure. Yeah. As I say, I don't expect a pivot. I think Powell's been very clear. And frankly, part of my forecast is, and part of my rationale out there is that I think the Fed is making potentially the biggest policy error in its history. I think we've broken inflation, and I think they're still backwards looking, and the bond market's telling you, and lots of the commodities are telling you that we have broken inflation, and that they should have stopped easing well before this. And yet, my guess is we certainly see another hike, whether it's quarter or half, in February, and probably another hike in March. At that point, I think they're likely to pause. I'm not necessarily believing they're going to pivot until I think you'll see a pause. And if we're going to get the kind of market move we get, I think we're going to get, Powell's not going to be happy with that. He has, I've spoken about this a lot, he has bought into Bill Dudley's, he gave a speech last April talking about the need to get the market down to 3,000 or lower, to tighten financial conditions. And until we did that, we had no chance of breaking the back of inflation. Powell has bought into that hook, line, and sinker ever since that date. And I think he's more interested or more focused on the stock market in terms of getting it down than he is the economy. And he keeps reiterating he's not worried about, if he puts us into a recession, that's necessary. But it really does seem like he's ignoring an awful lot of indicators that are saying you've already done your job, you've already gone too far, because I think all he wants now is to get that market down. And every time the market lifts its head, until very recently, he's sent his minions out to talk very hawkishly. It was as transparent as anything I've ever seen. They think they're being cute, but frankly, he's so easy to read. He wants that market down to 3,000 or lower. and he thinks he can't stop until then. If he follows through on that, we are going to see a global, I think we're going to see a global mess anyway, but it will be even worse. So my guess is he probably hikes for a couple more of these meetings and then gives it a rest, pauses, and then I think he probably, if we get anywhere near 6,000, he'll probably come back and hike again, thinking he's got, this is crazy. The risk has run away from us, and we've got to get a handle on this. My guess is you'll have commodity prices up, and he'll be worrying about inflation again. It'll be that second move into tightening, and I don't think it'll take many of them that will put us into what I call a global bust. And I define a global bust as something that's almost as damaging as a depression, but at the speed of a recession. So probably won't last much more in a year, but I think it'll be the biggest financial crisis in history, meaning bigger than 2008-9. And I think that could happen later this year. So as I say, 2023 could be as extreme to the upside and extreme to the downside as anything we've ever seen.
When with the situation you described, runaway risk is how it seems like you're describing it. If that's the situation, I would immediately think, how do we as investors kind of go in the fetal position and kind of get through it? Gold comes to mind as one of those options, right? Gold, precious metals, things like that. Gold stocks have obviously had a pretty good run. Spot gold has had a nice run as well, coming off the October lows, and now outperforming the S&P. Is that a surprise from what you've seen with gold? And do you see that sort of move continuing? Is that a good place to focus here, given the uncertainty you're describing?
Yeah, not a surprise to me. I actually, the surprise for me was last spring. I was expecting gold to do what it's doing now. Last spring, it started. If you go back to March and April, it peaked and it looked like it was ready to take off. And unfortunately, the dollar took off instead of gold. Yeah. And it tracks very much an inverse relationship, very close relationship there, where the dollar went from I think 95 to 115 in a matter of months, and gold went from to 2,100 down to 1620 or 50. So that was my surprise. What we've seen now, it really bottomed in late September with the dollar topping, and again, you're getting the inverse relationship there. And I have a call on the dollar that we'll see it certainly down to 90 this year, and I think we could see it down to 80 this year. So obviously, I'm very bullish gold. I think gold, very near term, is probably got another $100 in it here in the next couple of weeks, and then I would think if it pulls back at all, it'll be short term, and then I'm calling for 3,000 gold this year prior to the bust. So the bust will take all assets down, or all assets, but maybe treasuries. But I think prior to the bust, which means the next 6-7 months, I think you could see gold up to 3,000.
It's and what you described in there, you mentioned the dollar, and the strong dollar through most of 2021, much of 2022, I think surprised a lot of investors, particularly how much that muted the returns in gold. But we've seen quite a change in the fourth quarter, and now in the beginning of the new year, the dollar continuing to weaken. Is this a time for investors to be looking outside the U.S. maybe in a way they have not before, or what's your thinking of non-U.S. versus U.S. going forward?
Yeah, I think generally the U.S. is going to lead in performance. Yeah. I think you'll get sympathetic moves throughout the world. So, the EM stocks look like they're picking up speed. So that may be one area that does very well. Certainly the DAX has done very well near term and has outperformed the U.S. I think between now and the secular top, we're in a place where I expect ours to be a blow-off top. A lot of the world is not anywhere near where we are, I think, in that. So they're going to have sympathetic rallies, nice rallies, but I don't think I'm calling for the NASDAQ to go to 20,000. So that's a double off the lows. I don't think you're going to see that kind of move in the European markets or Canada or Australia or anywhere else. So I think they're certainly a place where they will play, but I wouldn't count on them. Maybe India is the one that has certainly shown in past where we had the strong market in 2020, 21. They also did. So And I don't follow India closely, but that would be the one where maybe they can keep pace with us. But the others, I think they'll be up, but not like ours.
David, it is always a pleasure to have you on. Thank you so much for talking through a number of different charts and a number of different themes. Be well and stay safe there in New Hampshire. We'll talk to you again soon.
Yeah, thanks, Dave. Thanks for having me on.
That's David Hunter. David's the chief market strategist at Contrarian Macro Advisors, coming to us from New Hampshire, and it's fascinating thinking of these different potential scenarios, right? How would that actually play out if you get an aggressive move to the upside? And he mentioned things like a melt up, runaway risk, something like that. Thinking of things like that and how that would actually play out, sort of a cascade of accumulation or distribution. It's certainly possible. If there's one thing I have learned in a number of years doing this sort of thing, is to be open to perspectives and really make yourself think about some different alternatives. Interesting thought process about what could happen here through the course of 2023. Such a great take, as always, from David Hunter at Contrarian Macro Advisors. We need to wrap our show, folks, and go to the 3 in 3. Here's 3 charts in 3 minutes that tell the story of this macro environment, this chart environment. Here's chart number 1. I mentioned the McClellan oscillator in our market recap, talking about the overall breadth conditions and how you've seen the market rally off of the October lows. It's been a broad rally, and you've seen a lot of individual names. It's gold, like we talked about with David Hunter. It's semiconductors and some technology. It's been healthcare time, a lot of materials and industrials with some really good runs off the lows. So how are the different ways we can define that using measures of breadth? The McClellan oscillator is one of those tools that is based on accumulation distribution data and looking at overall strength versus weakness based on broad or narrow advances and declines. The McClellan summation index is adapting that McClellan oscillator, adapting that breadth indicator into more of a time series over time and looking at the trends in the McClellan oscillator. Overall, you can see that the indicator made a new low in October as the S&P was making its own new low, getting down around 3,500. From there, the S&P has obviously rallied pretty strongly, now getting above trendline resistance, getting above the 200-day moving average. And the McClellan summation index broke out in mid-late November, pulled back again in late December, but in the new year has pushed now to the upside and is close to making a new 12-month, if not multiple year high. That strength in the summation index is another breadth indicator speaking to the underlying strength. It's not just a couple stocks leading the way. It's a lot of names that are really managing to push to the upside. Chart number 2 is NVIDIA. I mentioned semiconductors a couple times and thinking about this particular space. NVIDIA was one of the good gainers today, up about 2.5% today. We've seen a lot of breakouts in semiconductor stocks, and this is a group that had not been doing particularly well through much of 2022. The chart of NVIDIA, if you look at the relative strength at the bottom, is making a new relative low in September and October of last year. From there, just like gold stocks were leading from the lows, let's think about other areas of the market that were outperforming the S&P from mid-October to today. NVIDIA is one of those names. What's interesting about the chart of NVIDIA, a couple things. A bearish momentum divergence, November and December, higher prices, lower momentum, but it actually resulted to the upside, right? Pull back a little bit, but now has made a new swing high. You can see here the neckline for this inverted head and shoulders. We just broke above it this week. Getting above 200 would complete a break above the last Fibonacci resistance level. That's one to watch. Finally, Microsoft. Certain stocks have participated. Microsoft not there yet, up 3% today. But on a chart like this, just like the S&P getting above its 200-day, can Microsoft do that same thing? It has not done it yet. Folks, that's a wrap for the show. Special thank you to David Hunter of Contrarian Macro Advisors joining us from New England. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe, be well. See you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.